Good morning and welcome to today's webcast, Not-for-Profit Tax Update for Summer 2020. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Colleen Ramires, Tax Senior Manager, and Emina Cresswell, Tax Senior Manager. And with that, I will turn it over to Colleen to get us started.
Thanks, Emily, and hello, everybody. Today we're going to cover quite a bit of information. The IRS has been pretty busy as far as issuing guidance over the last 6 months or so. So first we're going to dive into the proposed regulations on the UBI activity siloing or bucketing, as we sometimes call it. Then we're going to get into the proposed regulations on the excess compensation excise tax. Then we'll go over some other tax updates, legislation that's happened, and then we'll briefly touch on COVID-19 legislation. There's lots of information out there, but still wouldn't be a tax update with touching on what's going on right now. So with that, we'll dive right in. So first we're going to cover the 512A6 proposed regulations going over the unrelated business income activities. So the proposed regulations in general follow the same approach that was provided in Notice 2018-67 that was issued in August of 2018. There are some changes that were made, and those are mainly what we're going to focus on. So first, kind of good news, I think that a lot of people feel like is good news, is in the notice, the IRS had suggested that the use of the North American Industry Classification System, or the NAICS codes, would be considered a reasonable basis when determining what is a separate activity. Well, the proposed regs came out and said that just the first 2 digits of the NAICS codes can be used. So with that, there's opportunity to look at activities that in 18 maybe had been separated into separate activities, and now because we're just looking at the first 2 digits for 19 and going forward, those 2 may be able to be grouped. I know a lot of our credit union clients, this is very applicable We found a lot of activities where they were separated in prior years, and now we're looking at being able to group them. Also, they clarified that activities that are in separate geographic locations, those can be combined. So you don't have to look at where it's being performed, you look at what is being performed, what the activity is. There were comments from the notice to request a de minimis threshold so that if it was under a certain amount, you didn't really have to worry about the bucketing. IRS rejected that. They also clarified that payments from controlled entities are aggregated by payer. It doesn't matter what that controlled entity, what their unrelated business activities may be. The activity separation is based on the controlled entity. It's not included in investment activity silo. So if you have a controlled entity that's paying you interest income and it's UBI because of the controlled entity aspect of it, that's not going to be able to get aggregated with other investment activities. Speaking of investment activities, the proposed regulations provided a little bit more information on what can be put into investment activities. The notice had provided information on investment partnerships. That was a big question of how those were going to get treated. So they provided a little bit more, they've changed a little bit of what's considered to be a qualifying partner interest or a QPI. They also provided some information on qualifying S corporation interest or a QSI, as we'll refer to it. They also clarified that debt finance property is going to be considered an investment activity. So what that means is if you've got investment partnerships that are considered to be a QPI, and then you've also got debt finance properties, those are now going to be able to be grouped. So I think that's more good news that we've got further consolidation that can be done. Do want to clarify that rent that's UBI because of where there's personal property, if more than 50% of it is personal property, if there's rent just from personal property, if there's services that's being provided with the rental income, those are not aggregated as investment activity. For those, you have to look to the 2-digit NAICS code for real estate, rental, and leasing, which is code 53. So diving a little bit more into qualifying partnership interests. So the IRS clarified that if an exempt organization doesn't significantly participate and they're not a general partnership, then as long as it meets one of two tests or two rules, then it can aggregate. It can either aggregate or it can be considered a QPI and be considered an investment activity. So the first two tests, the de minimis test and the control test, these are not new. These were provided in the notice. However, there has been changes when you look at what qualifies for those tests. So first, the de minimis test. So you just look at profit interest or capital interest, and if it's equal to or less than 2%, it qualifies. It's considered a QPI. In the notice before, you had to aggregate ownership. So you were looking at, controlled entities, supporting entities. You also had to look at disqualified persons. Now this kind of brought up some contention because disqualified persons, that's including board members, that's including substantial contributors. And as you can imagine, having to go out to your substantial contributors or even your board members and saying, hey, I need to know, what investments you have to figure out if we meet this test or not really something that a lot of, organizations wanted to venture into. So the IRS heard that, and with the de minimis test, it's just based on what the exempt organization owns. So if you own 2% or less, you can just check that box and you're done. If you don't meet that 2% test, then you can look at the control test. And the control test is if there's equal or less than 20% capital interest and there's no control. For this, there is some aggregation in looking at the 20% capital interest. So you need to look at what the exempt organization holds, what supporting organizations hold, and any controlled organizations hold. Again, though, they took out that disqualified persons. The proposed regulations also provided a little bit more information on what control is considered. So if the exempt organization can require the partnership to perform or prevent it from performing any act that significantly affects the partnership operations, it's considered to control the partnership. If it has the power to appoint, remove any partnership officers, employees, or a majority of directors, and if any officers, directors have rights of the exempt organization have rights to participate in management of or at any time conduct the business or the partnership, then they would be considered to have control. Now, again, you want to look at the 20% capital interest. So if you're over that 20%, it doesn't really matter if you have control or not, you're not going to be able to meet this control test. There's also the transition rules for certain investments that were owned when the notice came out in 2018, which we'll cover in a second. And then if you don't meet the control test for a partnership, there's a look-through rule that you can use in looking at a lower tier partnership. Really quick, for the percentages, or for the interest, it's determined using your Schedule K1 and looking at the beginning of year and end of year percentages. If you get a K1 and they just say various, you're going to need to go to the investment or go to the partnership and say, hey, I need the detail on this, because that's not something that can be relied upon. So on the look-through rule, if the control test isn't met, so we have this example, the limited partnership, there's a 50% capital interest that's owned by an exempt organization. Then you have to look at what activities, what unrelated activities is that partnership conducting. You also have to look at the lower tier investments that partnership has. When doing that, as long as the exempt organization doesn't control that top tier limited partnership, so the one that you have a 50% ownership in, when looking at the lower tier partnerships, you can apply the de minimis test. You can't apply the control test. That only applies to your direct investments, but the indirect investments, you can apply the de minimis test. So in our example, 50% capital owned by an exempt organization, that limited partnership owns in partnership A, and in partnership B, we've got a 4% and 10% interest. So for partnership A, when you take 50% of that 4%, you've got 2%. That qualifies for the de minimis. It's considered a qualified partnership investment. The 10%, 50% of that's 5%, that's over the 2%, so that's not considered to be a QPI. So then you're going to need to look at what activities that partnership is doing and potentially what investments that partnership has. For the transition rule, so any partnerships from the notice, any partnerships that were held as of August 21st, 2018, you don't have to look through them, so you can treat it as one activity. You're not having to look through and see what investments they have. You're not having to look through and see what activities. You can treat it as one activity. And that's even if they're not meeting the de minimis test or the control test. That doesn't necessarily mean that you can aggregate it with others. It just means that you're not having to look through that partnership. The proposed regulations clarified that if the partnership interest changes after August 21st, 2018, you still can continue to use this transition rule. This can be relied upon until the first day of the first taxable year after the proposed regs are published as final. So qualifying S Corp interest, generally an S corporation interest, it's treated as a separate, unrelated trade or business. You don't need to look through it. I imagine this is because for S corporations, it doesn't matter what activity is happening in the S corporation. Income from an S corporation is unrelated business income. So essentially, if you have an S corporation and it doesn't qualify for either the de minimis test or the control test, it doesn't really matter what activity it does, that S corporation is its own bucket. when that S corporation is sold and there's recognition of the gain or loss on that disposition, that can be aggregated with the activity, the ordinary income that was being generated by the S corporation. So, however, if you have an S corporation that is considered qualifying because it meets the de minimis or the control test, which is the same as for qualifying partnership interest, then you can aggregate that as an investment activity and aggregate it with other investment activities. With that, I'm going to turn it over to Emily to go into our first polling question.
All right, thank you. Our first polling question today: how excited are you that you no longer need to ask disqualified persons about their investments? And your options are A, I'm ecstatic; B, that's nice; C, wait, I was supposed to do that; or D, didn't apply. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and click Submit. We'll give everyone just a couple more seconds here. And let's go ahead and take a look at the results. Back to you.
Thanks, Emily. Okay, so kind of across the board, glad, I know there's been conversations that have been a little, uncomfortable. So yeah, having that that be removed was great. For those of you that didn't know that you were supposed to ask, well, now you don't have to worry about it. Oop. Oh, sorry about that. We are. All right, here we go. Sorry about that. The notice that was issued was said that the IRS was going to look further at expense allocations. Before it was kind of just based on a reasonable, method, and I think the IRS feels like some of times that's been taken advantage of. So they were going to look at providing more guidance around being more specific about how expenses can be allocated. Well, that didn't end up being provided in the proposed regulations. So they're going to provide a separate notice to come that's going to give that information. In the proposed regulations, however, they did say that the gross to gross method is not a reasonable allocation. So what that means is if you have gross income and then you've got the gross unrelated business income, using that percentage and just applying that to expenses is not a reasonable allocation of indirect expenses. So, looking at stuff based on employees and the time that they're spending, is one that's often used, looking at a usage of space. Again, more guidance is going to come on this, but the gross to gross method is not reasonable. They also, charitable contributions, before in the 2018 990T, that was listed kind of similar to the old 990Ts in that it was listed on each activity. So with that, you kind of had to allocate, we were having to allocate charitable contributions to each activity. Well, they've changed that. It's applied after the bucketing. So once all of the activities with net income are grouped together, then you're applying the charitable contributions. Also, they clarified that pre-2018 NOLs can be used prior to post-2017 NOLs. So your net operating losses that were grouped prior and can be applied to any bucket can be used first before you're having to use NOLs that are generated after 2017 that are subject to the siloing. NOLs were further had some adjustment with some of the COVID legislation that's come through, and that we'll discuss later on in the presentation. So with that, I'm going to turn it over to Emina to discuss the excess compensation excise tax. Emina?
Great, thank you. So another lovely topic, another new tax that the IRS has decided to add on and tack on. Excess compensation. So who does it apply to? It applies to the following organizations. So exempt organizations under 501(a)(1, farmers cooperative organizations, public utilities, organizations exempt under Section 115 as exercising essential government functions of a state or political subdivision, Section 527 political organizations, and also they said it includes federal and state chartered credit unions. So quite a few organizations are subject to it, and the rules are quite complex, and there's quite a bit to cover here. So what is the excise compensation tax, you might ask? Well, it's a 21% excise tax on tax-exempt organizations, often referred to as ATOs, applicable tax-exempt organizations, or I'll just refer them to tax-exempt organizations for our purposes here today. What's a covered employee? We'll cover that later. But essentially, it's covered employees who are paid in excess of $1 million by the filing organizations and related organizations, which we'll talk about in a little bit. And also, it includes excess parachute payments paid to covered employees, even if under the $1 million threshold. So we'll cover that also just a little bit. The proposed regulations were issued June 11th, 2020. So feels like just yesterday, but it's been over a little month and a half ago now. And the way this tax is computed is you apply it to taxable income, starting with your base W-2 wages, and then you add modifications to it. So let's say your 6/30 year end, you would use your calendar year 2019 W-2 wages to compute this tax. You'd use Form 4720 to report this. And the good news is there's no estimates that are due, but you can extend the form. So the due date for this form, let's say you are a 6/30 year end, is 11/15, and then you can extend it until 5/15. So if your calendar year, your due date would be 5/15 and can be extended until 11/15. So it really follows your organization's Form 990 filing due date. So that's good news on that front. All right, now that we've covered that, let's see if this will actually apply to you. So on to our second polling question.
All right, our second polling question. Do you think this tax will apply to your organization? And your options are A, yes, B, no, C, maybe, or D, not applicable. I'm just here for CPE. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll give everyone a couple more seconds on this. And let's go ahead and take a look at the results. Back to you.
Great, thanks, Emily. All right, so it looks like a few are yes, a majority are no, some are maybe, and then some are just here for some CPE. So that's good. So those that are maybe and yes, we'll be able to dive in some more, and those that are no, let's see and let's reassess. All right, so what are some things to watch out for when you do have excess compensation where it might apply to you? So 457F plans tend to be high dollars and can trigger compensation the year of vesting along with severance payments. So sometimes it can be large enough where it can be above the $1 million threshold, and you might be based upon W-2 wages close, but once you do the modifications and everything else, you could actually be over that and subject to the taxation. So who's a covered employee? Current or former employees, if they are one of the 5 highest compensated employees for the tax year, or was a covered employee for any tax year after 12/31/16. So we are going way far back. We're in 2020, so several years ago now. And what the IRS said, there is no dollar threshold for highly compensated. So what the IRS has confirmed, however, is that directors, so board officers, subject to different rules, but board directors are not employees. They also clarified when an officer is or is not an employee. So what the IRS looks at that is they find employees as consistent with the definition for employees for federal income tax withholding purposes, which includes common law employees, officers, or elected or appointed officials of governments or agencies or instrumentalities, and certain officers of corporations, What they've also said is an officer is an employee of the entity for which the officer serves as an officer, unless the officer performs no services or only minor services and neither receives or is entitled to receive any remuneration. So they kind of clarified and made sure that here's when you might have an officer be considered an employee and here's when you don't. And then some really good news here is they clarified that a volunteer is not an employee, however, if they meet an exception, which we'll talk about the exceptions briefly in just a little bit. So who's liable, right? The common law employer is the entity that's liable for the excise tax, but then only a tax-exempt organization has covered employees. But a covered employee could also be an employee of a related organization, which might cause the related organization to be subject to the excise tax too. So essentially what the IRS said, both organizations could be subject to it, but you would not double tax it. So the compensation would be taxed based upon specific steps that the IRS has provided within the prescribed rules, which we won't cover in detail as it's a bit complex and there's a lot still left to cover. Okay, so next is going to be talking about what is a related organization. So it's any person or governmental entity that controls or is controlled by applicable tax-exempt organization. It's also controlled by one or more persons which control the tax-exempt organization, is a Section 509A3 supported organization, along with a 509A3 supporting organization of the applicable tax-exempt organization. And then in the case of a 501c9 VEBA, it establishes or maintains or makes contributions to the VEBA. So control is very, very similarly defined as the IRS Schedule R, for example, reporting rules. So it also clarified that they use a control using Section 512B13, which states the following two things. The person has the power to remove and replace more than 50% of the organization's directors, or more than 50% of the organization's directors are trustees, directors, officers, employees, or agents of the person. So there are a few exceptions, however, under the control status. So for example, if the employee is a lower level employee and not acting as a representative of the organization. But what the IRS has said is then then they have to report it, that they are relying on this exception, and there has to be disclosures essentially saying, hey, we're using this exception from control. Now that we've covered the underlying definitions, we should also dive into the three exceptions that the IRS has issued under these proposed regulations. They've sort of expanded on one, but also added a couple more that we think are probably helpful to many organizations who might fit this fact pattern. It looks like we have a question real quick, and the question is whether this applies to C3 organizations. Yes, this applies to all tax-exempt organizations, 501c3s especially too. So yes, it does apply to all organizations that are tax-exempt under the IRS code. All right, let's talk about some exceptions. So the limited hours exception is basically when an individual will not be included as one of the 5 highest compensated employees if they meet both of these tests. So neither the tax-exempt organization nor any related tax-exempt compensated the individual for services performed as an employee of the tax-exempt organization, and the individual performed services as an employee of the tax-exempt for no more than 10% of the total hours or total days that the individual worked for in all related organizations during an applicable year. So what we say here with compensation, it also includes reimbursement. So you can't reimburse the related organizations too, as that's considered compensation for it. Good news here on this one is they did add a safe harbor provision where it says an employee who performs fewer than 100 hours of services as an employee of the tax-exempt organization and all related tax-exempt organizations during the year is treated as having worked less than the 10% rule. So it kind of, so you have to look and ask for the hours, and if they meet the hour requirements, then you're good to go and you meet this exception. The second exception, which is considered the non-exempt funds use exception, which this one is very, very similar to the volunteer exception on the Form 990 Part 7 when it comes to compensation disclosures. If an individual, and this individual has to meet all three of these tests too, so it's an all-inclusive test, it can't be one or the other. Neither the tax-exempt organization nor any related tax-exempt organization or taxable controlled entity of the tax-exempt organization compensated the individual for services performed as an employee. Again, this does include reimbursements, so watch out for those. The individual performed the services as an employee in all related tax-exempt organizations for less than 50% of the total hours or total days, and the individual worked for the applicable tax-exempt organization and all related organizations during a taxable year. So let's do an example right quick. So let's say the individual works 40 hours per week. 15 of those hours are for the applicable tax-exempt organization, and 25 are related hours for the related taxable organization. So in this case, 25 hours and 15 hours, that would equal they provide services to the related organization, and they would meet this exception. Then, or another example that we get to see also is when they work full-time for 3.5 months for the tax-exempt organization, and then they switch gears and they work rest of the year for the taxable organization, that would also qualify for this exception, whereby the services are done to the related organization versus the tax-exempt. And then the third one is, again, just kind of reiterating, no related organizations that compensate the individual provide services for a fee to the tax-exempt organization, related tax organization, or the taxable controlled entities. Essentially, here you'd have to look at, okay, who are we related to? Who are our employees listed on Part 7? And who do we need to look through and see if they qualify for these exceptions? Because otherwise, you might have to pull in your organization, your related organizations, and it doesn't matter if you're tax exempt or not tax exempt. You have to essentially look at your overarching org chart, essentially, to see if you need to pull in some more people. Exception number 3, this one was already part of the initial IRS notice that they issued back in 2019. It's the limited service exception, and what the IRS has done here in these proposed regulations is they just clarified that the tax-exempt organization paid less than 10% of its employees' total remuneration for services to the tax-exempt organization and all related organizations for an applicable tax year. And then number 2, another item is a related tax-exempt organization either paid at least 10% of the total compensation in all related organizations or paid more compensation than the applicable tax organization paid to the employee for the year. So it's kind of looking at who's paying who more and what kind of services are provided, and is it 10% or less. So the 10% seems to crop up quite a bit all throughout the regulations. So the good news is the IRS did provide a little bit of clarification. There are examples in the proposed regulations that we can kind of lean on and see what the IRS's thought process is. So the IRS, and us too, we think that this is quite taxpayer friendly, considering that how encompassing this entire related organization rule was. So hopefully comment period is still occurring, so the IRS is awaiting more comments from the public, the AICPA and other practitioners, to see what else they can incorporate here and what clarifications are needed on these proposed regulations. And then finally, once we've talked about the exceptions, we also mentioned the excess parachute payment. That particular item clarified that an excess parachute payment is a payment to a covered employee. So going back to the definition of the covered employee that we talked about earlier, and the payment is compensatory and contingent on employee separation from employment with the employer. And what they have clarified here is that it is based upon only if the employee it's an involuntary separation. And then the IRS goes through several examples where what they consider involuntary separation. So I won't go into the details here because we think this likely may not apply to too many, but wanted it to get out there and have it on your radar as well. And the way this one is computed is you take the aggregate present value of the payment, and if it exceeds 3 times the base amount, and in this case, the base amount is computed by looking at the last 5 tax years of the compensation, and then you average that out, and then you take that times 3. I make it sound a lot simpler, but it's really not, because you have to do present value, and there's a little bit more in discounting and things like that to account for in this computation. But essentially is, if it's 3 times the base compensation of the individual, then you might be subject to it, because this particular item is, even if it's below the $1 million, you could be subject to it. So what we say here, and there's a question on Schedule J of the Form 990 that asks, on Part 1, that asks, did you have a severance or change of control payment? Yes or no? And when you answer yes, it really would be good to look at and see how much was the severance payments and how much was this individual previously compensated, to see whether this would apply. So again, just reiterating, this is not the $1 million threshold. It's a whole different threshold. So the different component altogether under this excise tax rule. Whew, covered a lot. There's, I'm sure, going to be a lot of questions, but more to come for sure once we have final regulations. We'll hopefully have a few more clarifications and a few items that are still questionable. Let's dive into the next topic, however, and that's some other tax updates, because the IRS has been just super, super busy in dealing with tax reform, so the TCJA Act, and many other things following after that. So some good news here. Our favorite topic is the repeal of tax on the certain fringe benefits. I sure was glad when that happened. I'm sure many of you were pretty relieved as well that you do not have to go through the exercise of figuring out how much your light bulbs use in your parking lot and what the expense related to that is, and then getting taxed on it. So the Further Consolidation Act repealed that. It was signed into law December 20th, 2019. And it essentially repealed the provisions that was part of the Tax Cuts and Jobs Act, whereby qualified transportation benefits, qualified parking facilities, as well as the on-premise athletic facilities are no longer taxable to tax-exempt organization. Good news is it is retroactive back to the date of enactment, so you can go back and file amended tax returns to claim a refund on the related tax liability that you've paid, or in the case where you didn't actually have a liability and you used up NOLs, so net operating losses from pre-2018, to cover this tax, you can adjust your NOL carryover by attaching a statement to the tax return and showing that you've adjusted it based upon the repeal of this tax provision, and therefore you'll just essentially get that NOL back again. Some other hot topics. Oh, looks like we've got a polling question. So have you amended your 990T? Let's see. Emily?
All right, our third polling question, have you amended your 990T to claim a refund for the repeal of the qualified transportation fringe benefit? And your options are A, yes, B, no, C, should I, or D, not applicable. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. We'll give everyone another moment here. And let's go ahead and take a look at the results. Back to you, Emina.
Great. So pretty much across the board, some say not applicable, some said no, some said yes, and then some are, should I? Well, maybe you should consider it. Talk to your tax practitioner or contact us and we can help you out. All right, some other interesting and exciting news from the IRS is private foundation-wise, what they've done is they've changed the 2020 Appropriation Act as well. Established a flat rate of 1.39% on the net investment income. Historically, it used to be 2 tiers, so either you were a 1% or 2% excess taxpayer based upon your minimum distribution requirement, and it was a whole computation. And this is effective for tax years beginning after December 20th, 2019. So some good news for some bad news for others. a flat rate that was in existence. They've been talking about doing this for a long time, and they actually ended up pulling the trigger on this. So some other exciting news is group exemption rulings. So the IRS issued notice 2020-36, which was issued in May of this year. It applies to both new and pre-existing group rulings. And essentially what the IRS says is we're not accepting requests as of June 17th, 2020 until the final revenue procedures are issued. And what we've done here is we've listed kind of what is a central organization requirement. So you have to have at least 5 subordinate organizations, only 1 group exemption letter allowed per central organization, general supervision and control, and then supplemental group ruling information is due within 30 days after the central organization's year end. And then what we've also included here is just a quick definition of what is considered a subordinate organization requirement, so authorization to central organization, described in same paragraph as a Section 501c3 as central organization. Section C3 subordinates must have the same public charity status and a similar purpose based upon the National Taxonomy of Exempt Entities Code for non-Section 501c3s, uniform governing instrument, and certain organizations are not eligible to be subordinate organizations. So the IRS essentially put the applications on hold until further guidance is issued on these group exempt rulings. Some other sort of exciting news, maybe for some, not so much for others, but the Form 990 and the Form 990-PF must be e-filed, and this is effective for tax years beginning on or after July 2nd, 2019. So historically, what the IRS has done is allowed certain taxpayers to paper file, and now they've just mandated it for all to make it I think is probably to help avoid processing errors or losing papers. I mean, it happens, life happens sometimes. What the IRS has also clarified that when you had application pending, a box checked, you could not e-file, but you had to paper file. And so what they're saying now is if you're checking this box, you can e-file for 2020 forms. What's also super, super exciting, I think, in my opinion, and just going through this whole COVID situation and having to paper file 990Ts and coordinating how to get them all to the IRS timely and signatures and all that fun stuff, the IRS has issued that they said the 990T will be expected to be e-fileable for 2020 forms, but more to come. We're hoping that actually does happen. And then the Form 990-EZ, they have delayed that particular e-file mandate up to 2 years due to undue burden, as the 990-EZs typically are a lot smaller tax-exempt organizations. And then a pretty big change, I would say, for tax practitioners along with tax-exempt organizations is that the Form 1023, which is the application for exemption, is now required to be completed and submitted through the pay.gov website. So historically, we used to be able to get PDFs, have back and forth with our clients, and be able to then submit all the paperwork and all the necessary attachments via just doing a paper filing, whereas now you have to complete the entire application online and then do all your necessary attachment through this online platform. So it might be easier for some, but that's kind of still up in the air, and we're working with the IRS on figuring out how to make it easier for everyone to work through this. Some other things, more to come. Donor advised funds, always been a hot topic with the IRS. They see possible abuse with some of donor advised funds and getting charitable deductions, so they are definitely looking at that, trying to provide a little bit more clarity and guidance. As Colleen mentioned, the expense allocation for the 990T has been in the works for many, many years and has always been a subject that many organizations have always wanted some guidance on, and practitioners too. And sort of excited, yay, we'll finally have some guidance, but they also did clarify, as Colleen mentioned, that the gross to gross method is no longer acceptable. Some other things, the excise tax on endowments, and then self-dealing guidance regarding private foundation investing in a partnership in which a disqualified person is also a partner. So IRS has been busy with just other regulations, other rules, other notices, tax reform from a couple years ago now, and then, of course, COVID-19 legislation. So with that, I'm going to turn it over to Colleen to wrap it up with some COVID-19 legislation updates.
Thanks, Emina. So COVID-19, it's affected everybody. With that, there's been lots and lots of legislation. First, though, we're going to touch on, we're going to do a polling question just to get an idea of, where maybe some more questions are related to some of the legislation. Emily?
All right, our fourth polling question, what COVID-19 legislation do you have the most questions on? And your options are A, deferral of employer taxes, C, employer tax credits, C, NOL carryback, D, loan programs, or E, all of it. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. All right, let's go ahead and take a look at what everyone has to say. Back to you, Colleen.
Thanks. Employer tax credit seems to be that, and the loan programs, or all of it. Yes, there's questions of all of it. I'd say, especially with the loan programs, seems like it's quieted down a little bit, but definitely things are changing day by day. They come out and say there's different requirements. There's been legislation that has definitely, changed things on a continual basis. So just kind of high level, the relief legislation that's been out there, there's been quite a bit. In addition to this, since we put these slides together, the Paycheck Protection Program Extension Act that was signed into law officially on July 3rd, 2020. And what that did was the application time frame for that ended on June 30th. So this act, it extended it until August 8th. The Congress is working on more legislation right now, looking at further stimulus, just because this, the COVID and the shutdown and the effects are going a lot longer, I think, than was anticipated when the initial legislation was passed in March. So definitely more to come on that. So there were several payroll tax relief that was provided in the CARES Act. One was the employer payroll tax deferral. So employers can defer the employer portion of FICA, so the 6.2% of tax, through the end of this year, so through 12/31/2020. After that, 50% of that deferral is then due by the end of 2021, and then the other 50% is due by the end of 2022. With the PPP legislation, the Flexibility Act that was passed, they did clarify that organizations that have PPP loans, originally, if you had a PPP loan, you could defer taxes until it was forgiven. Now, Congress has said, even if it's forgiven before 12/31/2020, you can still use the deferral. So essentially, this is open to pretty much all employers. The paid sick and leave credit, this relates to the Family First Coronavirus Response Act that was passed in March, related to certain paid and sick leave, that new requirements. So if you have less than 500 full-time equivalent and part-time equivalent employees, it's a refundable credit. So if the credit is more than what would be owed in taxes, you can get a refund for it. I've included a link to our insight that goes into more detail on these credits. One of the big ones for any organizations that aren't utilizing a PPP loan is the Employee Retention Tax Credit. It's also a refundable payroll tax credit. So if there's more credit than tax would be due, you can get a refund of that amount. You can also, this only applies to the federal, or not federal, to the employer portion, but if you have excess, you can apply that towards other, towards offsetting other taxes. The credit is up to $5,000 per employee per year. Organizations that are eligible if they've been subject to a government suspension of operations, and that's a full or partial suspension, or there's a year-over-year decrease of gross receipts of 50%. And it's applicable for each quarter until either the full or partial suspension has been lifted, or if you're utilizing the 50% decrease in gross receipts until the quarter where year-over-year gross receipts are at 80% or above. And it would be, that quarter would be the last quarter. So if you hit 82% gross receipts compared to prior year in a quarter, that doesn't mean that that quarter is no longer applicable. It means that's the last quarter, and the next quarter you're not able to apply the tax credit. I will say, so I think something that's key here is a government partial suspension. So if only a part of your operations have been suspended, you can still apply for this. So a good example is in the healthcare space. Obviously, healthcare is pretty essential. However, there were some services that were deemed non-essential and were affected by some of the shutdowns. So for example, dental operations or elective surgeries. So because those were suspended, those organizations can be considered to have a partial suspension of operations. For organizations with less than 100 full-time equivalent employees, all wages count regardless of services performed. So you're not having to look at if there's a reduction in services. Essentially, you can get a credit for the employee wages that you're paying. For organizations that have more than 100, you're looking at wages that are paid to employees that are not providing services or have a reduction in services. So if you have an employee and they're only able to provide, say, 60% of the services that they did before, but you're still paying them 100% of their compensation, a portion of their wages could be applicable in this tax credit. Also, qualified wages include qualified health plan expenses. So if you have employees that you furloughed, but you're still paying their you're still paying their health insurance, that qualifies as well. And then, as I mentioned, if you have a PPP loan, you're not able to take advantage of this. I've also got a link that goes into one of our articles that provides more information. I would say with this, I think there's a lot of organizations that don't think that this would apply. They either think that they're not eligible, or that their employees are still providing services. But those organizations that we've worked with and kind of looked closer at that, we've often found more often than not that there is, it does apply. Maybe it's not 100%, maybe it's not the full $5,000 per employee, but $5,000 or $1,000 or something like that per employee, that adds up pretty quick, and it can turn into a pretty decent credit. So it's definitely something to at least, have a conversation with your tax advisor, reach out to us. We've got people that are solely focused on these credits, and we can definitely help kind of take a look and see if this is something that you might be able to take advantage of. So NOL modifications, the CARES Act that was passed now allows for NOLs to be carried back 5 years and allows for NOL offsets to be 100%. So the Tax Cut and Jobs Act cut off the ability to carry back NOLs beginning, losses in 2018, and then also only 80% of losses could be applied towards income, or only 80% of income in the future could be offset by losses. Well, then COVID hit, so we kind of undid all of that. With exempt organizations, kind of the monkey wrench that gets thrown into it is, well, we've got this siloing now that's going on. So there was clarification that if you're taking 18, 19, or 20 losses and carrying them back to pre-2018 years, you can aggregate those. So even if you have losses from 2 separate activities, when you take it back to pre-18, you can essentially just sum them all up together and offset it against income. Any that's carried then forward to 18, 19, and 20, it's still subject to that siloing. Something also to kind of take a look at, as I mentioned, at the beginning, with the change in how the NAICS codes are being applied, you may have activities that were separate in 18 but now are combined in 19. So if you have losses in 19 that you're trying to apply to 18, you may want to still look at the activities that have now been grouped together for 19, because those may still be subject to the separate bucketing that happened in 18. There hasn't really been guidance or clarification on it, but just something that needs to be considered. And then key funding opportunities, the Paycheck Protection Program. We're not going to go into this too much just because you could spend an hour, 2 hours probably just talking about this. I do have a link again to articles that we have. If you go to mossadams.com, we have an entire page that is committed to COVID, entire sections that are committed to the Paycheck Protection Program. And we're updating it on a continual basis as more information comes out. Right now, most people I think that have applied, that are going to apply for it, have applied for it. So now it's a matter of looking at, the loan forgiveness. There was legislation that was passed the beginning of June that took the 8-week covered period and extended it to 24 weeks covered period. They also extended the date where you have to get, employment back up to 2019 amounts from June 30th to December 31st. Also, there was, the SBA came out saying there's a certain amount that you have to allocate to payroll. That was 75%. The legislation reduced that down to 60%. For those organizations that had applied before this legislation was passed, there's the opportunity to stick with those the 8 weeks, June 30th and whatnot, or to elect to move to these extended dates. So we've been helping a lot of clients kind of analyze that and see if it's, if it's worth that. We've been helping clients, look at verifying how much of the loan is forgivable, documenting that stuff, and just, answering questions, obviously, because there's lots and lots of questions around it. Also, there is the SBA Economic Injury Disaster Loan, or EIDL loan, EIDL as I've heard it. It's up to $2 million for working capital needs, and there was a $10,000 grant advance that was it was a grant, so it didn't have to be paid back. That advance did close the 13th of this month, so that's no longer available. And that advance does affect the loan forgiveness, portion of the loan forgiveness of the Paycheck Protection Program. And then also the Federal Reserve came out with a Main Street lending program. Originally, they had said it wasn't applicable for not-for-profit organizations. They did just recently come out with a separate program specifically for not-for-profit organizations. With this, it's not a forgivable loan. It's just, better terms than maybe you could get on the regular lending market. There are equity and compensation restrictions for borrowers. And again, like I mentioned, mossadams.com, we've got lots of information on all of the different COVID aspects, updated as, soon as there's new legislation or more information coming out, we've got that on there. There's also a slide at the end of the slide deck that just goes into more information about all of the COVID stuff. With that, I think we have a minute or two for some questions.
All right. If you have any questions for our presenters today, you may submit them in the Q&A window. You can probably squeeze in one, maybe two. Let's see what we have. If a direct partnership investment does not meet one of the test or rules, what analysis is needed then?
So if the de minimis test or the control test isn't met, if you're not able to use the transition rule or the look-through rule, so you're going to have to look at the partnership and you're going to have to see what activities are they doing. So if they've got separate unrelated business activities, you're going to have to report that separately. And that's just because generally the IRS considers a partner in a partnership conducting the activities of the partnership themselves. And then also you're going to have to look at the investments that that partnership has and potentially the investments of that investment. So thankfully, you know, I think a lot of the tests or the rules are going to be applicable. So a lot of this analysis isn't going to have to happen, but there's going to be cases where there's going to be extra work and we're going to, you know, that you're going to have to work with investment advisors or even go to the partnerships and ask, you know, for more details about that partnership's investments and activities and whatnot. And with that, I think we are at time.
We are. We did have a lot of questions come in today, and if we didn't have a chance to answer your question, we will do our best to follow up with you after the webcast. Thank you, Colleen and Emina, for a great presentation today. We certainly covered a lot of material. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.